Good afternoon, everyone, and welcome to Quest Trust Company's Self-Directed IRA Saturday. I'm Steve Sabaji. I am the IRA specialist who works in the Austin office. So greetings from Austin today. And we have a very good presentation for you today. He's a favorite of ours here at Quest Trust Company. He's a man who needs probably very little introduction at all. Today we have with us Eddie Speed, who is going to be giving his presentation, which I think is going to be important to a lot of people for a lot of different reasons, regardless of the investing that you do. The title of Eddie's presentation is A Tsunami of Non-Performing Notes Coming Down the Pike in 2022. So this is going to be a lot of good information to take in and to absorb and follow up on. Again, those of you who maybe aren't as familiar with Eddie, as I said before, he does a lot of work with us here at Quest Trust Company. He is the founder of NoteSchool, and he's somebody that a lot of our clients have had a lot of success with over the years. But before we get into the presentation, I'm going to give you just a brief overview of Quest and who we are and some of the things we do. First of all, Quest Trust Company is the largest self-directed IRA custodian in the state of Texas, and we are one of the largest in the country. Nationwide, we have a clientele of over 20,000 active investors, and that is everywhere nationwide. We currently have in excess of $2 billion in assets under administration. We have more than 100 employees, many of whom are highly credentialed in the IRA field, meaning that they have gotten additional education and training through the American Bankers Association in the specific area of IRAs. And as it stands now, we have about 350 to 400 million of our investors' money just in cash, which means we have people looking for deals. So if you are a syndicator or if you are looking to borrow money, these networking events that we have that are coming up will be incredibly valuable to you. So I hope you will take advantage of them in the near future. Now, just a quick overview real quick and just a reminder, the purposes of our presentation today are purely for educational purposes. And always remember that before you enter into any transaction, that you should be doing your due diligence on the people that you're working with, and you will want to perhaps consult with your legal, tax, and/or investment advisors before entering into any transactions. All right, so self-directed IRAs, what are they? Well, a self-directed IRA, I would argue actually that any IRA is self-directed, because really with an IRA, you're taking your money and you're figuring out where you want to put it. You have that ability to choose where you invest. The distinction with a self-directed IRA, however, is that you really get to pick the investment. You choose the asset you are investing in. And what I mean by that is if you go to Vanguard, let's say, you buy Vanguard funds, you buy their products that they manage. With the self-directed IRA, you specifically say, I want that piece of property. I want that note. I want to be in that syndication deal. So they may be options that aren't widely available to other people, but you get that option to put your money into it. Now, it also offers all those same benefits of a self-directed IRA. First of all, that being diversification. You really do diversify beyond what the stock market does into an asset that isn't going to be in XYZ mutual fund or something like that. And when we're talking about real estate or real estate related assets, we know we're talking about an asset that doesn't correlate to the stock market. So it really is true diversification. IRAs, as we all know, have a lot of tax savings potential. Money can be deductible going in, it's deferred while it's in there, and there are a number of cases with certain types of accounts where it's tax-free coming out. So that is something that's critical. It also gives you the ability to really kind of invest in what you know the best. You know, when you're the one who's picking the asset, you've done your due diligence, you've done your homework. You should be should not be very surprised with the outcome because of the fact that you've done all the research on it. And the last thing I like to think of with self-directed IRA investing is that there is a little bit of a social benefit to the investing that is potentially found. You know, when you are buying that eyesore of a house in the neighborhood and you're putting money into it to flip it or rent it, you know, you're first of all taking an active investment interest in your community. You are investing resources, which is providing jobs. It's also stimulating the economy in terms of the materials that you're buying. You know, there are a host of things that you do as an investor in real estate that really can have a ripple effect beyond just the investment. And let's not forget, you're creating a better property. So you are creating a better overall community as well. Now, the types of accounts that you can set up, I'd say they fall into three buckets: the personal, the employer plans, and then the specialty plans. On the personal side, we have the traditional and the Roth. The traditional is largely these days used a lot for rollover IRAs. So any money that is coming out of that 401k plan that was all pre-tax, we can park it in there, keep it completely tax deferred until we start taking money out. The Roth, that is, again, one of the big tools that's out there for you to use. The Roth lets you make after-tax contributions to it. However, qualified distributions down the road are tax-free. The employer plans, they come in a bunch of different categories here. They allow you to put significantly more money in them than a personal IRA, that being the traditional or the Roth. And they're ideal for people who are small business owners. So if you want to learn more about those and the options that they have, please reach out to us as IRA specialists. We can consult with you on that. And then the specialty plans, there are two options here, both of which I think are really great tools for savings for healthcare and education. The healthcare savings account, the health savings plan rather, it's one of the things I like the most. You know, you can deduct the contributions. It's tax deferred when it's going in while it's in there, and it's tax-free coming out if it's used for qualified medical expenses. It's the only thing that's truly triple tax-free. And the education savings account, it allows you to make contributions on behalf of a minor child, and distributions that come out of there are also completely tax-free if they are used for qualified educational expenses. The thing I like about the education savings account too is it doesn't have to just be for college. It's something you can use prior to college for expenses for your children. So again, all of these are incredibly valuable tools. And if you have more questions, please reach out and we can explain them all. Now, just very quickly, I'm going to go through some events that we have that are coming up. First of all is our self-directed IRA socials that we are resuming live. So the first week of the month, it's in Houston. Second Tuesday of the month, it's in Austin. Third Tuesday of the month is Dallas. And this month, if you're in any of those areas, we've got a lot of great presentations that will be coming up there. In Houston, I'm going to be going down because it's going to be focusing on our cryptocurrency offering now. So if you've been dying to learn more about that, which based on phone calls I've been taking, I think a lot of you have been, but you'll have a representative from ErisX who's running the platform we use that will be there to, again, explain a lot of what they do, and we can talk about setting you up if you're interested. Let's see, in Austin, let's see, next week we are going to have Steve Vigil. Oh, right, okay, he's done some presentations for us before, and he's going to talk about the real cost of borrowing. Again, another great topic. And then finally in Dallas, and again, I'll be there in Dallas myself. I'm going up for that one. We're going to have Brad Sumrock, who's, again, a guy a lot of our clients have worked with, very well respected. And I love his title too. His title is How to Retire in 5 Years with Apartment Investing. I'm going to be talking to him about that quite a bit myself, I think. All right. So other things we have going on, again, the same stuff that we do all the time for you. So things like Self-Directed IRA Saturday here, the weekly classes that we do. We still are doing our virtual happy hour, which if you haven't used that, it's a great way to expand your overall reach with our nationwide clientele. That's going to be the fourth week, every fourth Wednesday of the month. And then, of course, you can always find our information. It's always archived on YouTube and on Facebook and our website. So if you ever miss anything, or if you want to go back and see if there's something of interest, go check it out. Finally, Quest Expo, we're very excited. This is going live again. I think this is the first time we've been live in 3 years. So we are still at a phase where we are discounting tickets for early purchase. So if you're interested, this is going to be a great event. We're going to have speakers from all over talking about all the different areas of self-directed investing you can do. And the other nice thing that I like about Expo, the Quest Expo, is that it's going to give you a chance to meet vendors and you can really build your team. That's I think one of the most critical things that sometimes people don't appreciate with self-directed investing. Who's going to help them with managing the property? Who's going to help them with repairs and other little things that go along with investing this way? So it's going to be a great way to get educated and meet all kinds of fascinating people who are going to be able to help you the utmost with your self-directed IRAs. All right, just to wrap up real quick. So if you want to reach out to me, scan that QR code. The QR code goes to my calendar directly. Pick a time that's convenient for you. I'll give you a call. You can also always go onto our website and use our chat box. It's always manned. There's always an IRA specialist available to either chat with you or give you a call. You can just use our phone number. Reach out anytime. You can use that number. My extension is 3554 if you want to talk to me. And then, of course, you can just shoot me an email. Whatever works best for you. We hope to hear from you sometime in the near future. All right. So with that, are we ready, Eddie?
Yes, sir. I'm ready.
All right. I'm going to drop off. I'll be coming back toward the end. We're going to invite all questions, of course. Just go ahead and drop them in the chat box. And at the end, I'll come back and we'll do some Q&A.
That sounds great. I'm ready to roll.
Right. Take it away.
Okay. Well, hello, everybody. Happy Saturday to you. I am actually filming this today. I'm in a little small town in North Texas, Nocona. And we have a pretty active land business up here that we do. So we use the note business in various ways and also including creating seller financing. So let's talk today about really where we're at in the market. And I started doing this in 1980. So I've seen a lot of cycles. And I want to ask you a question to start, and that is, any bargains in this boom market? Are there any bargains, or is everything pricey? Is everything maybe even slightly overpriced, right? So I have this question that people ask us a lot, and I think it's relevant today. And if you've seen me present with Quest in the last couple of years, you've probably seen me use this diagram more than once, but the bullets aren't the same. I move the bullets depending on what I think the most current market relevant conversation is. So what's great in the iceberg situation, what's above the water, and that is we have low unemployment. If you have friends or family that or yourself that are looking to upgrade your employment, you are probably in the most opportunistic situation that you've been in since I've been an adult, right? So low unemployment and rising salaries, and then we have a raging real estate market. And so that is the obvious, and we certainly are not in argument or in denying that in any way. But there are some things that are kind of below the water, not as good. Well, maybe they could be good. maybe this is where the bargains are. Maybe this is where the opportunity is. And so it would be several things. One of which is we're going to show you some pretty solid numbers and data numbers today. There's over 2 million mortgages that are in default, not making payments. What's normal? What's a normal market? What was normal before the virus? What became the new norm during the virus? And where are we at now? And we're going to talk about that, and we're going to have some good analytics that are really going to make us hopefully aware. And I think as we were talking about earlier, whether this buying these loans is particularly your interest, or you're just trying to have an awareness of what market conditions are out there, this should be very helpful to you. I think a lot of people are unaware of the non-performing loan market and what that market is relative to how it could affect real estate. The burnout landlord factor, there are 17 million homes owned by small-time landlords. And those landlords, 3/4 of them choose to self-manage. That is according to Urban Institute. And there's a big factor, and NoteSchool teaches this a lot. This is not what we teach today, but we teach on this subject a lot, how to go buy a property in a very advantageous way from a frustrated landlord. And you can even exit it with offering seller financing. So we've got some strategies there that we think are very opportunistic to the market. A lot of people don't know this, but it's the mortgage qualification standards have tightened since the virus. And so about 30% of people, the underwriting standard has changed so that 30% of the people that could get a mortgage before the virus can't qualify today. And that's not because of high interest rates. That's just because of other underwriting standards. So understand that we do have a mortgage credit availability issue that is out there. And then last thing, of course, we have a rising rate market. So how does that going to affect things? I think you should pay attention to that. And by the way, NoteSchool TV does a market update once a month and try to do a good job of really digging into these things. So the bargain in the boom market, and yes, I absolutely believe 100% that the bargain in the boom market at the moment is definitely non-performing notes. So we're going to talk about why that's true. We're going to talk about some prior market conditions, why this market is different. And while I've been doing this since 1980, I'm going to, full transparency, I've never bought delinquent notes in a boom real estate market. I bought lots of delinquent notes, tens of thousands, but I did them in a different market condition. Usually real estate was going down in value. So there's some market conditions that are different, and we are aggressively pursuing this in our company model, and I'm training people to do this a lot. Maybe this is of interest to you. Maybe it's a fit. Maybe it's something that I show you that you hadn't considered, or maybe you've been kind of thinking about this. So first of all, let's just talk about the norm. So if we go back in here, and once again, these are loans that end up at the foreclosure auction, okay? So this color right here are foreclosures. And obviously this was a huge market condition, but if you go back in here and you really measure from here to here, there were about 200,000 foreclosures on an annual basis. Now I got that number from auction.com. The data guy for auction.com was a guest on my NoteSchool TV a few weeks ago, Darren Bloomquist, long friend of mine in the industry. And so there were 200,000 foreclosures on an annual basis. Now, what's interesting is when this happened, and obviously this was the beginning of the virus, we went to a very different number. And so then all of a sudden we're looking at about 35,000 foreclosures a year during the virus. This is, once again, both of these are on an annual basis. And so when you look at these numbers and you start really realizing, by the way, auction.com does 50% of all the residential foreclosures in the United States. So they're obviously very focused on the numbers and their analytics and how it affects the market. There's a gap. Hint, hint, there's a gap. What happened to all these loans that would have normally cycled in foreclosure? You see, we're talking about loans that were delinquent before the virus. Plus, we're talking about loans that have become delinquent because of the virus. And how that combination of loans and how big is that pile? What does that look like? How does that work? Why does that matter? So let's look at loans in forbearance, right? These are loans that are in forbearance. And I know this report is slightly dated, but a lot of these data reports that we get are always going to be 60 days old or something like that. There's just no other way to avoid it. So there's not any more recent data, and we're fairly sure based on the trends that we're seeing in the market that this number is still fairly close to accurate. There's not a big tail off happening that's changing it. So these loans that are in forbearance, these are currently just under 800,000 loans. And of course, that's according to Black Knight. And as I said, these analytics are dated. We are very accustomed to that. I want to point it out so you're not like, oh my gosh, he's using old stuff, because it takes them a while to gather all this information and put it together. So just under 800,000 loans in forbearance. What is forbearance? Forbearance is a legal agreement the borrower has with the lender that says we're not going to pay, and we're not going to pay, and we're not technically in default, right? It's a timeout. Now, let's look at what happened when all this started, when the virus started. There was 8.3 million loans entered the forbearance during the pandemic. Well, now most of them have gone away, right? They're now performing again, or they paid off, or they've been serviced or transferred out, right? And all of that represents a market condition. We currently have 9% of those loans, that are currently in forbearance, right? 9% of the 8.3 million. So what happened? Where are those loans and why does it matter? So these are loans that are delinquent, that are in mitigation. What? There are 581,000 delinquent in mitigation, and that's a huge number. And so what happened? They said we want to restart. We want to sign modification documents. We want to get modified so we can do this again. And so they did. Here's the problem. 72% of that 581,000 loans are not making payments. Is that a factor? That's a big factor, right? That is a huge factor. So the loans that are here, which is about 5%, and this 5% represents, call it, about 400,000 loans. They are loans that are delinquent and not in loss mitigation. Another 400,000 loans here are not making payments. So this is a huge, huge factor. This is gigantic, because these are the loans that we were almost certain, well, they're going to get modified and they're going to start paying again, and they're not going to ever be forced to hit the real estate market. But here's the bigger thing. This is the small end of the story. Forbearance is what everybody knew about, what everybody talked about. I've had it brought up to me call it hundreds of times. The truth of the matter is, this is a piece of the problem, but this is not the major part of the problem. The major part of the problem are loans, and this is a very current report. Thank you, Black Knight. This is a very current report, and this report reflects loans that are delinquent, that are past due, or they're in foreclosure. They are not in forbearance. These are the other pile of loans, and that's 1,946,000 loans. Call it almost 2 million. So that's a did you know? Because I've presented this type of information to some of the most sophisticated house flipping masterminds in the United States over the last few months. And I would say that the top 500 house flippers in the United States, that a very low percentage of them are aware of these numbers. Does this change how you look at things? Am I calling for a bomb? I'm simply saying that if we're saying that this shortage of properties, this shortage of listings is affecting real estate, there is some significant shadow inventory on the horizon. Do I personally believe that we're in for a bomb? I think we're in for a flattening. Am I wrong? Am I right? Who knows? I've never lived through a pandemic before. Have you? Right? So everything that maybe should have happened in the market didn't, but we're paying attention to it. But we're buying these delinquent notes in a very different market and climate than we have bought loans in the past. Now, what's happening to these loans is they're getting packaged up and resold in the market. This was a $1.1 billion trade, Ginnie Mae. Those would have been FHA loans. And and they were based in California, New York, Florida, Texas, Maryland, and New Jersey. That's where the assets were located. But here's the thing. Here's the truth of the matter is, it's 4,500 loans. $1 billion worth is 4,500 loans. We're talking 2 million loans. This is like a huge principal amount of money. It's huge. And we just can't wrap our mind around how big it is or how big the impact is. So I took this little scale that I showed you a while ago, and I broke this scale down because this becomes a lot easier to see what happened in certain market segments. So this was prior to 2008. Now you can see here foreclosures and defaults. Look at the blue. Defaults were on the rise starting in 2005. It may not have been in the news, but it was a story that if you were paying attention to it, and I was telling people we were headed for an issue. It wasn't brain surgery. It wasn't like I was the most incredible visionary that's ever been. You can look at the data and see that. Then comes along 2008. Now that's when we all relate to the bomb happening. But with the bomb growing before then, yeah, you can see it. Look at the default line here, right? Look at the blue. So that's obviously a factor. Now let's look at when the foreclosures really happened, which was after 2008. Were there foreclosures in 2008? Yes. Were there massively more foreclosures after 2008? Yes. So, in fact, in 2010, cumulatively, and it's a little hard to tell because, this was happening on a monthly basis. But if you add the numbers up, in 2010, there was 1 million foreclosures in the year of 2010. Am I calling for a 2008 all over again? No. Am I saying there's excessively more delinquent loans than people are aware of, and that produces opportunity? And we got to wash through some assets? The obvious answer is yes. So then all of a sudden the market kind of calmed down. And as I said, in here from about 2006 through the end of 2018, there were about 200,000 foreclosures on an annual basis. And that is according to auction.com. So this was the norm, and I would say a good market, right? This was a bad market all in here, right? All in this market in here was not a good market, but this became a good market. This was a good real estate market. So we didn't have excessive foreclosures, but we had more foreclosures than we would have dreamed. Now all of a sudden you see this incredible cutoff, like boom, like we hit a wall, the market stopped. Pretty significant. What happens to those loans? Would we have normally cycled at 200,000 foreclosures a year? Auction.com says yes, but we didn't. Why? Because the court system, the federal system, the state system, the county system, they stopped doing foreclosures, right? And so now we have to go take those delinquent notes, said to be about 500,000, and we got to go move those loans over here and go start the foreclosure process all over again. Those are called legacy loans. You might have read about them. And those are loans that were delinquent before the virus. Every delinquent note that we have bought so far in this new market cycle, every delinquent note we bought has been a loan that was delinquent before the virus started. Legacy loans. The average delinquency is over 40 months. So the legacy loans are washing through the system. And what else is going to be future inventory of non-performing notes? Well, the answer is there's 2 million loans that, in addition to these loans, are going to get either or have gotten or going to get a notice of default. Are all of those loans going to end up at the courthouse? Are they all going to end up at the foreclosure sale? No, they won't. But does that mean that this could change the inventory of available properties? I think common sense tells us it has to. There's no way it can't affect us. Am I calling for a real estate crash as a result of this? I'm really not. But I am saying that I have never bought delinquent notes in a boom real estate market. And right now it's very interesting. So we're going to talk about what was historical versus what we see today. And I think this comparison that I'm going to build a story around will make sense to you. It'll help us see exactly where we are. First of all, let's just talk about the concept of how notes are traded in the secondary market, the mortgage industry. How does this work? If Eddie says I'm going to buy delinquent notes, am I going to call the local bank, the First National Bank, and call them for their delinquent notes? The answer is no, that's not what you're going to do. That's not how the industry liquidates this problem. So let's just go through a little bit of what is the normal industry standard, right? So home buyer buys a property, they get a house, they get the keys to the house, and if they don't have all cash, what do? They get a mortgage. They sign a mortgage note, and then they make their payments over a long period of time, 20 or 30 years. And then they've signed this note. What are the components of a mortgage note? Well, it's going to have a principal amount that's owed. It's going to have an interest rate. It's going to have monthly payments, and it's going to be amortized over a certain period of time. Call it 30 years. The buyer then signs the mortgage note, puts his John Hancock on the note, and now you have a piece of paper that is an asset. It is secured by a piece of real estate. You don't actually own the real estate. You're the bank. You own the note. So you've heard it called various things: paper, home loan, a mortgage, all of those things. So if I use any of those terms today, they're somewhat interchangeable because they all really are the same thing. So if you make your payments over time to the bank, and just every month, clink, clink, you click off, making your payment to the bank. and send it to the bank's mailbox, then what's going to happen is over a long period of time, the bank's going to say you were successful, right? And we're going to give you a release of your mortgage. You're going to have a deed to the property with no debt against it. Free and clear, we call it, right? And so that's a successful loan. We'll all agree upon that. That's what happens to the majority of mortgages in the nation. But there's some piece of mortgages in the nation that don't have that successful strategy. They have less than successful. So if they're not paid, what do the banks do? How does it work? And why does it matter? Okay. Defaulted loans are typically boxed up and resold. So they're resold, they're gathered up, and they're put in bundles. You saw that Ginnie Mae pool, that $1 billion pool of 4,500 notes. And if you watch the reports, you're going to see these coming out like almost weekly, right? If you're paying attention to mortgage banking magazines and loan servicer magazines and default management magazines and stuff like that, or newspapers, a lot of online newspapers, DS News, Housing Wire, Mortgage Report, all these things, which we do, and we monitor literally every day. So that's how we're gathering the information and feel like that we can keep our pulse on the market. So hedge funds typically buy these gigantic packages. I don't know about you, but not a lot of people I know have $1 billion sitting in their checking account, right? So hedge funds go in there and they make these gigantic trades. And then they will typically re-aggregate part of those loans to be sold, and they split that portfolio up because some percentage of those loans, call it every time, are not going to fit their purchase criteria. And so this is an industry standard. There's a network of these groups. We're very involved with them. We've known these guys. We know their servicers. We know people that do asset management for them. We know vendors for them of various types. And so this is sort of a network that we pay a lot of attention to. The good news for you is there are trade platforms where you can buy these notes today that you don't have to be as connected as we are, right? We have a trade platform. We have former students that have trade platforms. So there's various places that these loans are put in the market, and you can go buy a mortgage note just like buying something off of eBay. So now, why does NoteSchool fill in? Well, NoteSchool's found out for people that, for some people it's appropriate. They want some more training. They want information. They want to know what we've learned in 40 years of doing this that might be meaningful for them to know. So it's a good bargain. It's a good compromise, right? So these loans are then put out in the marketplace, and they can be bought by investors as little as one at a time, right? So when they do that, the first thing you have to do is understand what is you would need to know to buy an asset. Now, there's a lot of little riddles. There's things that I could say, but let me just simply say this. Due diligence is a part of every investment that we ever make. Unless you just want to go hand your money to Wall Street and you expect them to go do everything for you, and you're just going to shut your eyes and say, I hope those guys make a good decision with my 401k money. What we found is people have money in self-directed retirement accounts. There's some kind of a disbelief that that's the best way for them to do things, right? So this audience, you guys are guys that want to control your own investments. You want to make more of your own decisions. I do the same thing. I'm not really for just giving it to some guy and hoping he figures it all out. But I will say that helping people with what due diligence is and how due diligence works, and is there a simple process, a path people can follow, it makes a huge difference in how they look at a deal. So once you do that, you agree upon a price, and then you wire the money to the hedge fund. And basically from there, you get the assets. Now, we have a capital fund, and this is sort of typical of how we've done it, but it shows you how one investor at a time might do it as well. So the bank gathers up all these loans. They end up selling a big box of these loans to the hedge fund. Once again, the hedge fund strips out smaller segments of that gigantic portfolio, and they'll end up selling it to firms like ours, right? Now, we might buy 100 loans at a time or 300 loans at a time. And then what we do from there is that we go put our assets, our trade platform is called NoteSdirect. And there's other platforms that we show students how to use, not just ours. And then those assets on NoteSdirect are just literally one note at a time. But that's the waterfall. This is how loans end up there. So no, I don't care who tells you differently. From a 40-year veteran perspective, don't go call your local bank and think that that's how you're going to go find delinquent notes. There's an accounting process. There's a process that banks go through to do it. And this is an efficient system that has proven to work well for us to go acquire notes. Now, black swan markets, I've lived through a lot of them, right? 1986, 1980, 1986, all of these were loans that had delinquent note characteristics, right? Every one of these had a significant amount of delinquent notes. Now, the mother load was obviously 2008, the most delinquent notes that I'd ever seen. Back in here, I bought loans from the government. The government sold loans called the Resolution Trust Corporation, which was a combination of where the government had so many defaulted loans, they had to form their own entity to get rid of them. That was very big in Texas and the Southwest. But these loans in this last cycle that I described to you, this is this new paradigm of the market is how the hedge funds buy these loans and reaggregate them in the market. And this became very prevalent in the last cycle. And this is exactly what's happened in this cycle. So let's go back a little bit and let's just look at that. Now, we were teaching people, I want to show you this. We've been teaching people to buy delinquent notes a long time. This was Market Watch, and they wrote an article about NoteSchool. So NoteSchool was the article that was written about us and teaching people to flip mortgages like they were flipping houses. So let's look back after 2008. What was typical? What was a normal deal? Let's just say the property value was $100,000. We might have not only the cost of the note, but the foreclosure cost and the interest cost and the covering insurance while the house was vacant and having the house secured and paying back taxes and all of those, everything that would have been involved in buying a delinquent note. Let's say we had about $50,000 in it. So understand, we're buying the property at 50 cents on the dollar, right? And we were buying the property because they owed so much money. They owed such an incredible amount of money that they were 50,000 underwater. They owed 50,000 more than the house was worth. I would say this was probably true 95% of the time after 2008. So we did this. We taught thousands of students to go do this, and a lot of them did it with Quest retirement accounts. And so let's look at what happened when somebody bought this note after 2008. So you buy the delinquent note, you pay cash for the note. Remember, you're going to pay cash for the note at a deep discount because you couldn't buy this note at not a deep discount because they owed so much more than even what the collateral was worth, the property. Then you had what we called a workout strategy. Now, some of these people, we could modify them and get them paying again, right? 40% of the time. Now, remember, we were buying a note at 30 cents on the dollar. So we could afford to be crazy benevolent and modify these loans and get them paying again. 20% of the time, they just deeded over to us, and 40% of the time, we had to take it through to foreclosure. So those are sort of the three options that we had after 2008, right? So if you modified a loan, then all of a sudden now you have a reperforming note and they're paying again, right? And that would happen about 40% of the time. So that's good. Now you went from a non-performing note, you rehabbed it, and now it's paying again. Then if you've got a deed in lieu of foreclosure or a foreclosure, then you had three options. You could either wholesale the house, you could sell or finance it, or you could just keep it as a rental, all of which we've got incredible NoteSchool student stories. And then it's just, quite honestly, it's just a rinse and repeat process, right? It's just rinse and repeat to go do this. But here's what happened. After 2008, remember, we're focused on a prior market, just so that you can see where we were versus where we are today. Then you had to go through, call it a pretty long foreclosure process. Now, I picked 10 months. Not every state is 10 months, but probably the average nationwide was about 10 months, right? Then you foreclosed, and because they owed way more than the property's worth, they certainly couldn't pay it off at foreclosure. So now you end up with the real estate owned, REO, right? And then you had to go do real estate management. Now you're selling a property in a down market. So if you're selling it in a down market, it's going to take you a while to sell it. And you're going to have to take care of it. You have to do a lot of things before you get your REO sold. So your cycle time, look at the green plus the orange, your cycle time is pretty long. Your knowledge base is long. Your work factor is long. There just was more to it. It wasn't that it wasn't profitable. It was just a lot to it. So now, all of a sudden, let's look forward into the 2022 market and understand the current NPL, non-performing loan, right? That's the industry acronym for it, non-performing loans. Is it like 2008? Not even close. It's not anything like that market. Why is that true? So now let's look at what a loan is more likely to look at in today's market. And we're going to say this is true. Nothing is ever true 100% of the time. We all know that. This is true probably 75% of the time plus. So this is the majority of the story, not 100% of the story. There'll be unique stories within everyone. So the typical asset value we're seeing is about a $225,000 house. Typical legal balance, legal collectible balance. Now remember, they haven't paid for years. So they have a lot of accrued interest. The lender has had to pay their taxes, pay their insurance, pay for, all these various other expenses so that the lender's loans remain secured and wasn't at risk of losing it for taxes or whatever case. So now they have got a lot of money to bring current this loan. And in this case, you buy that loan for $130,000. You say, well, Eddie, that's not near as big a discount as it used to be. True, but it's not the same kind of deal, right? Let's talk about what this current note looks like. So we're buying loans that well over 50% of the time, the foreclosure is already in motion, right? Now, remember, virtually all the loans we're seeing at the moment are loans that are what? Legacy loans. They're loans that were delinquent before the virus. The lender's already started the foreclosure, so we have to finish the foreclosure. So when we buy it, and our remaining foreclosure is the green part. The prior lender's already done this. It's already happened. So I just step in line of what he's already started. And then we get the property back. Well, wait a minute. Are we going to have to go do all the REO management like we used to? No, because a high percentage of the time, these are equitable loans. Remember, the property was worth $225. They only owed $175. Somebody buys it to foreclosure and bids out a price higher than the lender's payoff. That means we don't end up with a property at foreclosure. We just got our loan paid off. Or hopefully the buyer's got a lot of equity and he sees that and he wants to pay us off even prior to the foreclosure date. What does this mean? It's pretty simple. It means that the time element is way less. Time, attention, sophistication, the management processes, your money's tied up. All of these things are a very different cycle. So this is not the same old non-performing note business that I've seen in pretty much every real estate cycle in the past. And we're watching this unfold because it is new for us, but we understand what happens, all right? Here's a case study of a student. So this is Jay Redding. Jay Redding has his account, his IRA account. He buys assets in his IRA account with Quest. And so here's the property, 1,400 square feet, and it was in Fort Wayne, Indiana. Now, some people say, well, I only do something in my backyard. Who cares where it's at, right? Jay doesn't have a tool belt in his back seat of his car and drive up there and go work on this house. Jay just bought the paper on it. He bought the mortgage on it. So he buys the paper, and their legal balance on this property was $85,000. Now, the default interest rate was 11%, and it was 20 years remaining. And so, but wait a minute, they're not paying. They haven't paid in years. So it doesn't matter what the rate would have been because they're not paying. Their payment was $390 a month. How does somebody default on a $390 payment? I have no idea, but they did. Jay buys this note. This is what to pay attention to. Jay buys this note, and he buys this note for $53,000. Now, wait a minute, Eddie. They owe $85,000. So Jay buys this property at a pretty decent discount. Now, Jay had some other money he had to spend, right? Additional expenses, because Jay had interest and foreclosure expenses and so forth. And this is the little legal piece of paper right here from the court. And that says this is what Jay's owed. What was interesting is their payoff of the loan was $61,000 principal. So this is all the other stuff other than the principal balance, and it makes it total this amount. This is going to be normal. This is the norm, right? All right. So this property was worth $145. And once again, this is in Fort Wayne, Indiana. It's not the hottest market in the country. Jay had $57,500 all in this deal, but he was at 39% of the property value. So was he at risk if he ended up owning the property? Let me ask it to you a different way. Would you be okay to own that house worth $145, and that's a real picture of that house, if you had $57,500 in it? I think we all agree, of course we would, Eddie. We'd do that. Now, the legal balance was $85, and so guess what happened? He earns the difference between what he had invested and the payoff, and he made $27,976 pretty quick. How quick? When Jay bought this deal, the lender had already taken it this far. Jay bought it and made the investment at that juncture. It took him that far to finish it, and he got paid off at that number. Pretty short cycle time, right? And this was an asset that traded on Notes Direct. Jay got paid off at the closing, and he makes $27,976 in a pretty short cycle time. Is this normal? This is a good deal, right? Is it extraordinary? Yeah, it's an extraordinary deal. Are there more deals that are extraordinary than this deal? I see them every day, right? So this is what NoteSchool teaches people how to go find. What is a good deal? What are you looking for? How do you do what Jay did, right? So here's what we've learned. What we've learned is what NoteSchool teaches. Really, there's three things. There's knowledge, there's interest in the subject. Some of you say, I'm not interested in non-conforming notes. Okay, I'm fine. The NoteSchool teaches other things. Maybe that would be a better interest to you. And then the time to go do it, right? What we've learned is all three of these have a minimum standard to be safe. So what we've learned is if somebody has I can't make you be interested in something you're not interested in. So the first thing I try to do is say, what we're doing a fit? Does it work for you? Does it make sense for you? And then secondly, if you have a high interest level, then how can we help you with knowledge and time management, right? How do you go do this and not go give up your day job? how do you go do this in lieu of trying to go find a bargain in the real estate space, right? So those are all things that are big variables in the market. And those are where we feel like NoteSchool has really filled the gap and done that. So this is your call to action. If I have said something today that you just want some more time to absorb this, we're not going to pressure you. We're not going to do anything inappropriate with you. We're going to send you what we would call a deal hack lab. So we're just going to take this story. We're going to intentionally repeat a little of it, maybe not said exactly the same way. And then we're going to add to it. We're going to show you more deals, more examples, more concepts, whatever. And then you can just spend some safe time by yourself. Now you're going to email us info@noteschool.com and just put in the subject line of your email, please. Just put Quest info on NPNs, non-performing notes, right? So once you do that, just so we know what presentation this is from, then my team then is going to be able to send you a good solid little video where we take it just to another step. I didn't have time to go do that today because I didn't want to waste your time if this didn't make sense to you. As I said, we are intentionally going to repeat a little bit of the concept today, and then we're going to keep taking it and going with it. Now, you may say, this isn't what I want to go do, Eddie. I want to go buy notes that are only paying. Or I may want to go figure out how to be a real estate investor and buy properties on creative term. We help people with those strategies too, and you can simply let us know that. We'll be happy to do that. But today we picked a specialist, and I can tell you that we are very seasoned in my shop. My team is extremely seasoned, decades and tens of thousands of transactions that they've closed. We are aggressively doing exactly the model that I showed you today. So you always wonder, like, is the guru really doing this? Are they really doing this? Let me tell you something. We're really doing this, and we're doing it in a pretty aggressive way. I think we're seasoned enough to know this is a bargain, right? I've been looking for a bargain too, right? This is a bargain, and that's why we're doing it. So I am going to pull the PowerPoint down at this point, and then that way I can see what kind of questions we have with you guys.
Sure. Okay. By the way, thanks, Eddie. That was really great information. We do have a couple of questions, and I know we're pushing up on 1 o'clock, so we may end up just cutting this a little short in lieu of everybody's time. But let me just pull out a couple of the things that I saw. Here's one. Okay. How many people paid the high price with low interest rates recently, and when it shifts to a low price, high interest rate, that's when the flood will happen? That's sort of the question, I guess, is in terms of framing it in terms of the situation and how it might cause effect.
Yeah, it is a smart question. There's no doubt. And the answer is if there were more of a balance in inventory, we would drastically see the market affected by rising rates. Rates are double what they were this time last year. They were about 2.5% a year ago. They're about 5% today. So that is a big factor. We certainly are paying attention to it. NoteSchool TV has some really good stuff on this. I mean, like, we cover this in really in-depth on a monthly basis. We just finished our market update this past week. So you guys can look at NoteSchool TV and look at some of these market updates. I think it'll be helpful to you. We're paying attention to your good question.
Yeah. And here's a question I get in one form or another a lot. And of course, these are questions as IRA specialists we don't really answer or can't answer. But the question is, if you were to guess, as we go through this delinquent notes period, will housing prices drop, or is there too much demand?
Let me just tell you something. Go watch our last NoteSchool TV. It takes 30 minutes to watch it, right? I see a lot of questions on here about the market. Let me tell you how I look at the market, Steve. I don't know anybody smart enough right now to pick exactly what's going to happen. I see a lot of people with a lot of hot sports opinions. What I would say is what we're trying to do is to provide you good market data. And obviously you see they lit the board up today, right? I'm pointing out things that people didn't know. Why didn't they know it? Because the truth of the matter is it's not in the mainstream press, right? We're not being told the entire story. We're being messaged what we want to be messaged by whoever wants to message us. I'm trying to lay it straight out there on the line and say, there's a lot to pay attention to. But let me just tell you something. There's a lot of factors. I am not calling for a 2008. Do I think there's a reset in the market? And do I think trees are going to grow to the sky like a lot of these guys are predicting? I'm not sure about that.
Okay. And I guess there was one last question. I think it was referring to the point you made when you were talking about those Ginnie Mae loans that were, I guess, getting called. And you mentioned a couple of areas, primarily on the East Coast. And somebody was just wondering.
That's just one portfolio.
Okay.
4,500 loans of $2.5 million.
Got it.
Don't draw any conclusions about that one portfolio other than it was example. That's $1 billion on less than 5,000 loans.
Yeah, yeah. Well, I think that might have been the thrust of the question was to see what other areas might be suffering similar situations like that. But it sounds like that could be almost anywhere.
Yeah.
Okay. Okay. Well, it is a little after 1 o'clock here in Austin. We have had, looks like close to right now or a little while ago, about 111 people on, and that number is starting to dwindle a little bit. So I think that we should end here. They have your contact information if they wish to follow up. And again, please feel free to reach out to us here at Quest if there's anything we can do. Other than that, I would just say thank you all for attending and have a great rest of your weekend. Thank you, Eddie.
Good to see you.
You too.
Bye-bye.
Bye.